All right, today we're going to tackle one of the most important, if not the most important numbers in options trading, the strike price. So let's break it all down, shall we?
Let me ask you a question. You insure your car against an accident, right? Of course you do. Well, what if I told you that you could do basically the same thing for your stock investments?
Because that's pretty much what a put option is. It acts just like an insurance policy, protecting you financially if a stock you own starts to take a nosedive. It's an incredibly powerful way to manage your risk.
Okay, so just like with any insurance, you have to choose your level of coverage. And in the world of options, that coverage, it's all defined by one single critical number. And that, my friends, is the strike price.
So, what is it? The strike price is the pre-agreed price where you get to exercise your option. Really, think of it as the trigger point. It's the exact stock price where your insurance kicks in and starts to do its job.
Theory is great, but let's make this real. Let's walk through an example. We'll use a hypothetical scenario with Teva stock to see how this actually works. Okay, so picture this. Teva stock is trading right now on the market for exactly $20 a share. You own some, but you're getting a little nervous that the price might drop soon, so you want to protect your investment. You decide to buy a put option, your insurance policy. But now you have a choice to make. At what price do you want that protection to start? Where are you going to set that trigger?
So here are your two main choices on the table. On one hand, you can pick a strike price of $19. Now, this gives you really high protection since it's super close to the current price, but that insurance premium is going to cost you $1 per share. Or you could set the strike price way down at $15. This is a lot cheaper, only 50 cents, but the stock has to fall a whole lot further before your protection actually kicks in. And this just lays out that fundamental trade-off perfectly. See, choosing that $19 strike means your protection starts almost immediately if the stock even just dips a little. But that security, well, it comes at a higher price. The $15 strike gives you less immediate protection, but it costs you half as much. So you might be asking yourself, why is one option so much more expensive than the other? Well, the logic behind the pricing is actually pretty intuitive when you think about it.
It all comes down to one thing: probability. The price of the option, which, by the way, is called the premium, is directly tied to how likely it is that the stock will actually hit that strike price. Just think about it. What's more likely? That a $20 stock will drop $1 to 19, or that it'll plummet all the way down to 15? The smaller drop is way more probable, right? So because a huge drop to $15 is less likely, the insurance against it is cheaper. And that's exactly why that option only costs 50 cents.
Now here's where things get really fascinating. What if you chose a strike price that's actually above the current stock price? Let's say you pick a strike of $24 for our $20 Teva stock. Can you even do that? Oh yeah, absolutely.
But an option like this would be a lot more expensive. And why is that? Well, because the stock at $20 is already below the $24 strike price. Your insurance is already in effect. It has what we call built-in or intrinsic value. You're basically buying an insurance policy that's already paying out. And yeah, that's going to cost you a whole lot more.
So, what's the final takeaway here? Choosing a strike price is always a strategic decision. It's this calculated balance between the security you want and the cost you're willing to pay for it.
So let's do a super quick recap. Remember, the strike price is your chosen level of protection. It's the trigger for your insurance. If the strike is closer to the current price, you get more protection, but it's more expensive. If it's further away, it's cheaper, but you have less protection. It really all boils down to that classic trade-off: security versus cost.
And that really leaves us with a final question for you to think about. This isn't just about numbers on a screen. It's about your personal strategy and your comfort level with risk. So when it comes to protecting your investments, what price are you willing to pay for peace of mind?